Okay, these last two videos are basically just going to give an indication of what the RBA has done with monetary policy in the last 4 years. So you can see we're kind of looking mainly at this period, sort of 2011 and onwards, although we will go back and just have a look at what happened during this GFC period, which had quite a dramatic impact on monetary policy settings. So, policy since 2007. So back in 2007 we had a Rudd government. What happened is that they were having, when he just got into power, there was quite strong economic times, and the RBA was looking to tighten monetary policy. So they raised interest rates from 6.25 to 6.75%. Some of the reasons for this, and you don't need to memorise this, but it's more just getting an understanding of, what are some things the RBA will look at when they're implementing monetary policy. But we had high underlying inflation, we had a really strong terms of trade, which was leading to increased growth and consumption within many industries. Unemployment was within our target range and quite low, which was causing wage pressures. Food and oil prices were quite high. We had tight labour markets, so there was strong demand for labour, which was causing wage pressures. Strong consumer confidence, and we were working really close to our capacity. And that's one key thing that will cause the RBA to tighten monetary policy if we're close to our productive capacity. The other thing that was happening during 2007 is that even though we had inflationary pressures, the budget was quite expansionary. They were implementing tax cuts, and they weren't really supporting the RBA in their pursuit for low inflation. One of the main reasons was the budget was so expansionary is because, one, they had a lot of money back then, and two, Rudd had just got into power, so he was trying to basically win an election at that stage. So that was causing them to be more expansionary budgetary policies, but it did make it harder for monetary policy. 2008, start of 2008, inflation was still not slowing down, so the RBA tightened monetary policy again to 7.25%. So it did go up, it was quite high during this period of time, and then the GFC hit. And when the GFC hit, it went bang. USA went into recession, there was a global slowdown, China slowed down a little bit, Europe struggled, and basically what happened is that the higher interest rates meant that our economy was struggling too. So we had household discretionary incomes were falling because of the lack of the high interest rates. There was lack of demand for loans, not only because people were now not confident about their future, and businesses, but interest rates were high as well, so that was making people reluctant to borrow. There was reduced availability of credit because of the high interest rates. The exchange rate was high because of high interest rates. And basically we were in this period where we had high interest rates and a weak economy, and that's exactly where we don't want to be at, because interest rates are having a pro-cyclical impact on the trough and causing the trough to be even higher. So late 2008, 2009, the RBA had a really big impact on the economy. They went from a highly contractionary stance to an expansionary stance with successive loosenings of monetary policy. So the cash rate fell from 7.25 to 3% from the period of 2008, September 2008 to April 2009. So there were 6 consecutive rate cuts to help avoid a recession. So every single month they cut them, often by more than 0.25%, sometimes 0.5%, to try and stimulate the economy and prevent us from entering a recession. So budgetary policy was highly expansionary with the stimulus packages and all these kinds of things we've talked about in the past. Monetary policy was also really expansionary to make us avoid a recession. The idea was to try and preserve household discretionary income and help us to try and spend more money because we had more cash flow, and tried to stabilise private sector confidence, so trying to get the private sector to try and invest more money as well and to grow. So the idea was just to be as expansionary as possible to try and get us out of this global financial crisis. And as you can see, this is where the GFC sort of started to hit. We had relatively high inflation, and even when inflation was just outside our range, the RBA knew they needed to loosen monetary policy because they knew what was happening in the future. And we did actually have one period of deflation during that period as well. Growth, you can see growth fell considerably in 2008, 2009 as well, because of the GFC. But the RBA argues, along with budgetary policy, that they saved us from recession. By cutting interest rates, by expansionary budgetary policy, by stimulating spending, they helped us to avoid a recession. So that's basically what happened in 2009. Then 2010 hit, and the economy actually started to emerge from the GFC. So inflation started to pick up, growth started to pick up, and the RBA went from an expansionary stance to a more neutral, and then to a more contractionary stance. So the signs that Australia was recovering from the slowdown, inflation was starting to emerge, China was really picking up, and our commodity prices were going through the roof. Consumer and business confidence was growing, unemployment was falling, so it fell to 4% again, which caused high wage pressures. We had a really strong property market, We were close to productive capacity, so we're kind of working in this sort of vertical zone. Budgetary policy was still relatively expansionary. Firms were investing because of the mining boom, and we had really strong credit growth. People were going into debt and a high terms of trade. So 2010, if you go back to this graph, way back here, you can see they actually tightened monetary policy only a couple of years after the GFC. And that was all to do with the fact that our economy got out of it and the strong commodity prices during that period of time. 2011, and I'll finish that off this video here, the RBA decided to loosen policy by 50 basis points because there were signs the economy was starting to slow down again. So the mining boom was still strong, and we still had skill shortages, and there was still low unemployment. However, there were some signs that inflation was starting to subside. So households were starting to save more. The dollar was quite high, so that was causing inflationary pressures to diminish. The property market started to slow down. That's when the European financial crisis kind of started to emerge, and growth in many European countries started to slow down. There were natural disasters, where natural disasters can cause inflation, but they also slow down the level of growth. And we're not too worried about the inflation from natural disasters because they're generally temporary things. There was slow growth in China and low confidence levels. So all of these things were signs that the economy was going to slow down, and therefore a sign for the RBA to perhaps become a little bit more expansionary in their stance.